Ladies and gentlemen, the markets are in turmoil. And in today's video, I want to talk about the 4 stocks that I am buying to take advantage of these dips. Now, I've made a little presentation for you guys as always, and there's a couple objectives to the types of stocks that I'll actually be looking at. So I always buy growth focused stocks. That means that their main goal is to actually grow in their market share. That sort of Jeff Bezos like approach. Your margin is my opportunity, right? I like technology stocks. I believe that digital is the future. Okay. So that is really where all these companies are going to be focused on. So even if you're looking at like a Celsius, for example, which might be a growth focused company taking market share, it is not going to be on this list. I love technology. Okay. And then long term tailwinds. So this falls into a little bit of the technology advantage, but I need long term holds, and I don't want this to be a slow or like a quick trade. I want this to be a slow hold, a company that continues to grow over time, makes me a fortune over the next 10 or even 15 years. But most importantly, these companies are going to be having large recent sell-offs that I believe are unwarranted. Okay, so let's go into the actual thing. First stock, SoFi Technologies Inc., ticker symbol SOFI. Now, this company has just recently seen a 31% sell-off, actually dropping down into the $11 ranges, all the way from $18.42, just dropping since January. And that was off some very great news that brought them to that price. Now, if you guys watch the channel, you know SoFi. Obviously, they are a digitally focused bank, so they end up going and acquiring members for financial services or lending. And there are some pretty great opportunities. So not only has their member base been growing like crazy, but they also expect that to grow all the way to 13.5 million by the end of 2025, or at least those are my predictions. Then, if you actually look at contribution margin, their net income margin, or adjusted EBITDA margin, every single one has been growing upward and upward and upward. So no matter how far down the line you go, SoFi is doing better and better. Now, starting out with the bull case, they actually acquired a company called Technisys that is going to be completely redoing their back end, so then they can be fully digital, one-stop core and ledger, and that's actually going to save them about $60 to $70 million just in terms of fees that they're paying out to other vendors to end up setting up their back end. Okay, so that's going to be amazing. That's finishing up in 2025. For the longest time, they have been continuously growing and bringing in these financial services members. Now, that is being heavily sorted towards financial services and not as much in the lending side. But there has been a massive breakthrough on the lending side. They now have the loan platform business. You can see here in some of the quotes that I put in here. In 2024, we originated $2.1 billion of loans through the loan platform business, which brought our total company originations to $23 billion. They started this loan platform business in Q3 of 2024, and yet it's already brought in $2.1 billion, or roughly about 10% of their overall originations. And this could potentially grow to as much as 100% of their originations, as they've even said on their lending side that they might not even want to put loans on their balance sheet anymore. They could just simply fund everything through the loan platform business, and that is only accounting right now for the personal loans, not student home loans or their credit cards. Now, he said, one of the things that we do contemplate is we could push all of our lending into the loan platform business over time, and I'm not opposed to that at all. The economics are very attractive. The velocity is much higher. The capital is lower. We have a lighter balance sheet. It would really support higher return on equity. Okay, so this is very exciting. This is the next real big bull case that I think a lot of people are not actually seeing. And now one of the things as well is, whenever you look at their newest products, they have loan servicing and they have the loan platform business. But on the loan servicing side, they've already said that SoFi servicing is now servicing all of our student loan account needs. Okay, so this could actually be for student loans very quickly. Now, the next leg of their business is Galileo. This is their technology platform. Now, I could go through all of the actual things there, but I'm going to assume most of you guys know what Galileo does. The main part, and the part that I don't think many people are thinking about whenever they research this company, is that they want to offer SoFi loans, brokerage, and Lantern Marketplace to the new technology services to the 50 million accounts that are on Galileo's partners, okay? Offer SoFi's loans, brokerage, and Lantern Marketplace to the new technology services. That now means that there could be a potential expanding the loan platform business to Galileo accounts. Okay. So instead of just getting $2 billion deals, we could see this being flooded in through the 50 plus million accounts that are on Galileo. Well, it's actually 168 million. That was an old slide. Okay. So that has grown like gangbusters over the last little bit. So right now, the loan platform business is growing like crazy, and that's only off of the 10 million members that SoFi has on their platform. What if they can expand this out to the 168 million accounts, which then makes Galileo even a better service offer whenever they go to their customers and say, hey, we have web and mobile banking, we have conversational banking, we have physical card issuance, we have all these products to sign you up to Galileo. But now what if we said, hey, we also have lending accounts and we can actually underwrite it better than anyone else can? This is an unbelievable moat, and I think that it's not being appreciated. The next part, that 31% sell-off, okay? I think it's completely unwarranted. And if SoFi can continue to hit their targets, just the midpoint of their 2026 EPS targets, which would be 68 cents, we're talking about 18 to 17 times what you could potentially buy SoFi for right now versus what you'd actually be getting in terms of their growth into the future. And that's if they hit the midpoint of their guidance, which historically they never have. They've always superseded the upside of their guidance, which means 80 cents plus. But that brings us on to stock number 2. It's NVIDIA Corp, ticker symbol NVDA. Full disclosure, this is the largest stock in my portfolio. Recently, there's been a 27% sell-off, which has hurt the portfolio, but still is the largest stock in my portfolio, okay? And right now, I believe that you can get quite the discount versus what you could get previously. There is a massive rush to enable artificial intelligence for every facet of the world, okay? This is going to be in every sector of every industry. And right now that's going into data centers as one of the fastest ways to get access to these GPUs will be enabled through cloud computing. So the second best architecture in the world was the Hopper platform. This was created by NVIDIA. That's second place only to the Blackwell platform, which was also created by NVIDIA. So you could see here what potentially a full stack of their options look like. Not only that, but their software side and their partner side is only getting larger as they continue to hold on to that market share, which means they can actually get better margins if you want to get, access to all of the training that they've already previously done, which means that they can deploy applications and libraries that are built up based on their total market share. So they're growing these libraries because they are some of the fastest growing right now. So they're actually benefiting greatly on their success, but it might actually mean that their success can stay quite sticky for quite a long period of time. Traditional data centers have been built on CPUs. It's been an essentially $1 trillion installed base of general purpose CPUs, which will go almost completely to accelerated data centers for artificial intelligence purposes, which means you're going to need GPUs. And then on top of that, there's another industry that is being created through AI factories. These are digital twins of every single business on Earth to potentially make sure that you are hitting the highest level of production, that you are understanding that there is ways that you could be doing things that are more efficient, faster, and more cost effective, or lowering your total cost of ownership. So that is really what NVIDIA likes to focus on. And this goes into the next leg of their business, which is robotics, autonomous vehicles, and essentially just general physical AI. If a car manufacturer wants to tap into NVIDIA's Drive OS, then you're getting a lot of the data in terms of how to, do the self-driving technology through all of the companies that have already existed on that platform, okay? And that's going to be the exact same way for warehouses or robots into the future, is that you are benefiting off of their learning already. Unlike humans that can potentially, each individual human has to learn lessons for themselves, robots are not like that. One robot drops a glass on the ground, every other robot will not do that again. This is their moat today. But tomorrow, they want to make sure that they can hold this moat. So they're not done thinking about, what they're building just on Blackwell. They're already thinking about Blackwell Ultra, which will be launched in 2025. And then this sort of rumored Rubin platform, which is now being processed for 2026, 2027. So this is the company of the future. And that's why you see growth like this. Okay. Insane compounded annual growth rates across the years, and this is only starting to explode now, and I do not think that this slows down for the rest of the decade, okay? Even into the future, you're seeing that next year, they expect around 56% growth, and then the year after that, about 21% growth. And I think that these are completely way less than what people should expect. If you actually think about what consensus revenue and consensus EPS for NVIDIA is, it has only gone one direction. They are revising up their earnings. And this is why not only does Wall Street have to continue to up their standards for this company, but even at the time of the earnings, they always beat, or at least for the large period of time, other than a small period in 2023. Okay. Now, this must be a very expensive business if you are going to grow at these sort of rates. Okay. But it's actually not true. NVIDIA on a price to earnings ratio is about the exact same price as Apple. 37.6 times to Apple's 37.5 times. And on a forward-looking basis, you have Apple staying around 31.2 times. And even on Wall Street's, in my opinion, wrong estimates of their earnings, because they are going to beat them, in my opinion, we're looking at a 24.6 times next year's earnings, which in my opinion is very cheap for a fast growing business. Apple's a good company, but I don't want to be paying the same price or even more for 1.5% growth over the last 3 years whenever I could be buying NVIDIA at a 70+% growth rate over the last 3 years, 69.25% growth rate. Leagues above the rest of the Mag 7 and drastically above Apple's. And this brings us into cash flow. Not only do they have a dividend, not only are they buying back tens and tens of billions of dollars of their stock, but they are one of the most cost-effective cash-generating businesses in the entire world. And probably by the end of next year, they will actually be the highest free cash flow generating business in the entire market. Number 3, Robinhood Markets, ticker symbol HOOD. All right. Large sell-off, the largest on the list, 32% since February, not even January. So this has not been a long time for this drop to occur, going from $65.57 all the way down to $40.95. At the time that I took this picture, $44, but it went as low as $41. Let's talk about the business here. Robinhood is a brokerage that brings on people, and they eventually actually get them to sign up for a gold subscription. Now, there's been a couple things that is very interesting to highlight. In Q4, they showed off 2.64 million people that are paying $5 a month for this gold subscription, which then brings on 6 times more assets under custody, higher deposit rate, and more chance that they acquire their other products. Okay. And yet, the new attach rate, which was at 10.5%, is now being highlighted by management to be above 12%, and that they're holding up a 30+% gold attach rate of the new cohorts that are coming over to the platform. And as you can see, that attach rate to Robinhood's retirement account is going very successfully. So not only are we seeing retirement accounts go up by 2x over the last year, and those retirement accounts, or the retirement dollars per account, has also skyrocketed, but this has led to retirement assets under custody 7xing over this last little bit. If we go back, if the more people that are coming onto gold, which is now at 3.1 million as of March, where they said that they highlighted that their first 2 months were doing great, this is leading to massive amounts of attach rate, assets under custody, and then leading to more retirement, which is then creating that cycle, once again bringing in more dollars for Robinhood. This leads average assets under custody per user to be at its all-time high in the business since being a public company. This leads their average revenue per user, even with user accounts climbing higher, to be at an all-time high for the company. And this goes even further to show off operating leverage. So look at this. Adjusted operating expenses were up 18% year over year and 9% sequentially, even though revenue grew over 114% year over year, yet expenses grew 18%. So what does that mean? Better margins. The company is absolutely printing. And yes, this is actually non-GAAP numbers. This is not taking into account the tax write-offs or the tax benefits that they had that would bump this margin up even higher. This is their true amount if there was no write-offs. Okay. Nearly $500 million, up from $150 million the quarter before, or $30 million the year before. That's more than 10x. Now, on a rule of 40, which is a combination of both adjusted EBITDA margin and year over year of total revenue, which, the golden standard is 40%, Robinhood is destroying this, leading to both individual numbers passing that rate and leading to a combined total of 106%. This is truly a phenomenal business. And there's so much more to come. So not only have they brought in so many new products that have allowed members to get very excited, but they have a gold event coming in March, a crypto event coming sometime mid-year, and a hood summit that's coming at the end of the year. And they said we could even do more if we accelerate faster than expectations, but they want to deliver more and more to their users. So there's no reason to not become a gold member. Now, in terms of the stock, it's in my opinion that they are going to enter the S&P 500 this year. They have all of the total check marks needed to join, and yet they are one of the fastest growing, well-capitalized businesses at good valuations to join the S&P 500. So I think that that's very much in their playbook here. Number 4, Alphabet Inc. or Google, ticker symbol GOOG, and sometimes an L. Google dropped since February, off 14% off its recent highs. This is not as much as the drops of the other companies that we've been following, but there still is so much to love for Google. So one, this sort of understanding that Google search is dying is just not showing up in the numbers. ChatGPT has been around for quite some time. Google is still holding up roughly a 90% market share of total search volume, okay? And on top of that, you're now seeing Gemini starting to be integrated into Google search, meaning that people have very little reason to want to leave whenever you have a very efficient model that'll be built right into the Google search platform, allowing them to also get so much more data than the potential, 300 million monthly active users on OpenAI, whenever you have potentially billions of users going to Google search. The speed at which they could grow could also be much, much faster. And that's not the only leg of their business. We also have Google Cloud, which in the most recent quarter is still holding up 30+% growth rates, a slight dip in their total percentage of revenue, but that's just because it's Q4. You see that every single Q4, okay? But overall, this is a growing percentage of their total business. And the cloud infrastructure as a total industry is one that is very, very sticky, one that Google has an advantage of with AI, which is what we're going to talk about next, and so much growth left that could potentially be taking place. Now, like I said, the AI advantage for Google is severe. Google DeepMind is amazing. It's at the forefront, cutting edge of artificial intelligence, and having that cloud infrastructure as well allows them to deploy these tools for people to actually, buy from Google and start utilizing to then, facilitate that growth even further. So this is not a business that is just growth at all costs. Their total share count is also going down very quickly. They're issuing dividends. They're issuing buybacks. This is a very, very well-capitalized business that is looking out for their shareholders and their shareholder returns. Every facet of their business that people want to focus on, from Google Cloud to Google Search, YouTube, or their devices and subscriptions, is growing very well. Free cash flow. Now, I put in CapEx year-over-year change. This is what's very interesting and actually goes to bode well for NVIDIA as well, is that we are seeing an insane level of growth here. If you look from 2018 all the way to about 2023, it's very hard for them even to get into the double digits, let alone in 2022, quite high, 27.78%. Last year, 63%, and next year is still expected to be plus 40% as well. So this is going to be an insane level of CapEx growth, all designed, by the way, to help that cloud growth, buying GPUs and helping NVIDIA's business. So these businesses also tie in well together. But even with that CapEx growth, you're still seeing large growth in free cash flow, okay? Then we have the moonshot projects. This is Waymo. Waymo is doing very well. They continue to grow faster and faster. This is their self-driving vehicles. 7 months ago, they were doing 50,000 rides. Most recently, they said 200,000 rides per week. Very exciting. And you can see in this Exhibit 6 over here, San Francisco is now actually showing, as of November of 2024, that they have passed Lyft in their total amount of market share in San Francisco. Then we look at quantum. So there was a big breakthrough through Willow, and there will be more breakthroughs going forward. But if you're thinking about the next leg of where the internet potentially goes, or the power of computing, Google wants to be at the forefront of that, and they're making some of the largest breakthroughs in quantum computing as well. Not only that, they want to be in the robotics game. So bring Google DeepMind into the Apptronic layer. They're also an investor in Apptronics, so they'll benefit off of their success if they become a large player in this robotics game. But Google wants to be a part of the future, and so they're sticking with robotics as well. And whenever you're looking at valuation, you could see Tesla, Nvidia, Apple, all of these guys near the top, but really Google far below even Meta being second place at 20.8 times their trailing 12-month basis. So this is a very cheap business. Now, like I said, shares are going down and efficiencies are going up. Not only are you being at the forefront of artificial intelligence, but that is going to help your business as well. And you can only suspect that their headcounts are going to stay flat to more downward over the next little bit as revenue per employee spikes way beyond the $2 million mark. But ladies and gentlemen, by far, these are the 4 companies that I am focused on buying in this dip. Now, that doesn't mean that this dip can't get dippier, okay? Things can get much worse before they end up recovering. This is why it's important to have a long-term mindset and that you stay focused on the future. This is not about making quick gains. This is about making generational wealth, and that's what I'm focused on with all 4 of these businesses.